The SPY ETF, or SPDR S&P 500 ETF Trust, is one of the most widely traded and well-known ETFs in the world. It's designed to track the performance of the S&P 500 index, which represents 500 of the largest publicly traded companies in the U.S. When you invest in SPY, you're essentially investing in a slice of the overall U.S. stock market, making it a great way to gain broad exposure to the economy. SPY holds the same companies as the S&P 500, including giants like Apple, Microsoft, Amazon, Tesla, and Alphabet Google. These companies span multiple industries like technology, healthcare, finance, and consumer goods. By investing in SPY, you're getting exposure to the biggest and most influential companies in the U.S., spread across various sectors. One of SPY's key strengths is its liquidity. It's one of the most traded ETFs in the world, with billions of dollars exchanged daily. This means you can easily buy or sell shares of SPY at any time during market hours without worrying about big price changes or delays. It's ideal for both long-term investors and short-term traders. However, SPY does have a slightly higher expense ratio compared to some similar ETFs, like VO. SPY's expense ratio is 0.09%, which means for every $10,000 invested, you're paying $9 annually in fees. While still very low compared to actively managed funds, it's a bit more than VO's 0.03%. That said, SPY's unparalleled liquidity and long history make it a top choice for many investors. SPY's performance mirrors the ups and downs of the S&P 500. Historically, the S&P 500 has delivered an average annual return of 8 to 10% over the long term. For example, if the S&P 500 rises by 10% in a year, SPY will also rise by around 10%, minus a tiny amount for fees. On the flip side, if the S&P 500 drops by 5%, SPY will fall by a similar amount. This close tracking makes SPY a reliable way to follow the broader market. A big advantage of SPY is diversification. It holds 500 companies across multiple sectors, reducing the risk of any one company or industry hurting your portfolio too much. For instance, if tech stocks are having a bad year, but healthcare or energy stocks are performing well, the losses in tech could be balanced out by gains in other sectors. This built-in diversification is one of the reasons SPY is so popular. Let's look at an example. If you invest $1,000 in SPY and the S&P 500 rises 10% over the year, your investment grows to $1,100, minus a small fee for the expense ratio. Conversely, if the market drops 5%, your $1,000 would shrink to $950. SPY is a simple way to follow the market without needing to pick individual stocks or worry about rebalancing your portfolio. In summary, SPY is a highly liquid, diversified ETF that gives you exposure to the 500 largest U.S. companies. It's an excellent choice for both new and experienced investors looking to track the broader market. While its fees are slightly higher than similar funds, its liquidity and long-standing reputation make it a top choice for building wealth